let's talk for a minute about basically the options within the plan. You know, when I was younger and working for large companies, um, they had they had specialists in the HR department that would help guide you through the process of signing up for a 401k. And sometimes they would have some financial person to help you pick the mutual funds.
Hmm.
Today, you're pretty much left on your own, which scares people.
Exactly.
And so sometimes they just, go for the safest option, but sometimes they just make bad decisions. So what can help people, especially in these small company plans, where they're not getting a lot of guidance? What can help them make these kind of decisions? Is that going to a financial advisor or what?
Well, you don't really need to make that step, especially when you first start out, if you familiarize yourself with the online tools. And a lot of people ignore online tools, retirement calculators, which help you to decide. The most important online tool is first determine what is your risk preference, or risk tolerance, as it sometimes says. You answer a few questions about your behavior when the market does what it does. It fluctuates. It goes up and it goes down.
What's risk tolerance?
Risk tolerance means when you are assessing your feelings when the market goes down, you shouldn't necessarily pick a portfolio that has a lot of volatility. You can moderate that a little bit so you don't get, like you said, freaked out and feel like you have to run and hide from the volatility. If you answer a series of questions, a portfolio can be determined. And by a portfolio, what we mean is a mix of assets. So you'll have some large company stocks, some small company stocks, and stocks represent ownership in companies. And you might have some international stocks, both large and small, ownership again. And you might have some bonds, which represent you're a creditor to a company. They're going to pay you a rate of interest for using your money. And it's as simple as that. And so you think that there's two major asset classes are stocks and bonds. Stocks have a bias toward growth, and bonds have a bias toward stability. So if you mix them in the portfolio, your portfolio will have some growth, but the bond position will help it in a down market not go down as far. So it moderates the volatility, and it grows your assets at a rate that you're comfortable with.
Okay, so when you're talking risk, they're going to ask you whether you're willing to take high risk, moderate risk, or low risk.
Exactly.
Basically.
Exactly.
And bonds are generally lower risk.
They're lower risk and lower volatility, but they don't grow as fast as stocks. So you have to balance everything. The whole issue is about balance.
Okay. Now we're talking about people who need help in picking various funds. Let's talk about target date funds.
Sure.
Because those funds are particularly aimed to help people who don't want to make hard choices about which mutual funds. So they're basically the year in which you're going to retire. So it might be a target date. It may be a target date fund for 2050 for somebody who may retire in it. So what do you think of target date funds?
Well, target date funds are useful for the reasons that you mentioned. Having an ability to have a professionally managed fund, which is geared to be more aggressive when you're young and then taper to less aggressive when you're close to retirement, is comforting for most people because they don't want to be charged with the responsibility of picking individual portfolio positions, which you wouldn't do in a risk-based fund either, because if you can have it professionally managed as well. But a target date fund is automatically more aggressive when you're young, gets less aggressive when you get close to retirement, because I think most people remember what happened in 2008, where if people were in an aggressive portfolio and the portfolio shrunk by 35 or 40 or 50%, they had two choices. They could either keep working or retire with a lot less money. And neither option was very comfortable. So a lot of people kept working. And I asked some of my clients, did you know anyone who was close to retirement in 2008. I said, yes. I said, well, what happened? And the answer was usually they kept working because retiring for half the money wasn't an option.